it would be great if you, ask as many questions as possible. That would be really helpful to help us kind of keep this a little bit more tidy as a topic. So please feel free to start adding questions or anything that you really want us to cover as the panelists. Let's see how many people are here. And of course, no one ever drives by my house until today, and there's like fire trucks going by, and usually silent where I live. All right. Well, how about we give it another 30 seconds or so, and we'll wait for a few more people to show up, and then we'll get started. All right, I'm not necessarily seeing anybody log in yet. So we had about 25 people RSVP'd. So I'll just wait. It's a couple seconds longer. All right, well, how about we get started? And the folks who log in after, we'll play a little bit of catch up. So that's fine. So first of all, thank you all for taking the time to attend today's session, brought to you by Horizons Foundation. We, the PAC, which is the Professional Advisors Council co-chairs, we got together and we were thinking about topics that we could bring to you all that were timely. And we thought, the one that's probably on the top of most everyone's mind is inflation. It's affecting all of us in different ways. So we thought we would start with that at the beginning of the year. And we've asked leaders in their fields to discuss inflation and the real estate market with us today. And we thought that because very often, our wealth and assets are very often tied to real estate and are usually a large portion of assets held, particularly here in the Bay Area. And, we know that needs to be really factored into financial planning. So we thought this is a good topic. And again, please do ask questions because this is such a wide-ranging topic. Real estate, inflation, they're huge. So it was really hard to kind of narrow this down. So your questions will also help us to kind of keep it timely and make sure that you get the questions or the things that you want to hear about answered in this discussion, because we could talk about this probably for the rest of the day in all directions. So please do that. That will help us tremendously as panelists. But before we get to hear from our speakers, I wanted to invite Jake Zalewski of Brio Financial, who is also the co-chair of the PAC, to give you a little bit of an update about what we are working on and some of the initiatives that we're hoping to accomplish this year, and a little bit more about the PAC if you don't already know. Jake?
Thank you, Henry. Hey, everyone, thanks for joining today and taking time out of your busy schedules. We do really appreciate it. As Henry mentioned, PAC stands for Professional Advisors Circle, and as probably most of you are aware, a key part of Horizon's mission is really to strengthen the cultural giving within the LGBTQ community. So the PAC is designed to create a forum of professional advisors who really serve this LGBTQ plus community and to help educate you on particular topics. The benefit of PAC is there's really networking opportunities. Now, as long as COVID, that's kind of what was really difficult, the networking during COVID versus outside of COVID. But events like this is one of the benefits. When we get back to social events, such as our Pride Luncheon, is another benefit. The visibility, being part of the PAC, directory on the Horizons website, and then of course volunteering, and we're going to talk a little bit about at the end. Volunteering in support of pro bono, which we're trying to coordinate for this year, and there'll be other educational events. So we want you to participate. We want your help. We want you to be involved so that we can really help this culture of giving within the LGBTQ community. Henry?
Thank you. And I wanted to say thank you to the other three co-chairs who helped put this on today. Linda Scaparati, who's also on the call, Jamie Santos, who just joined the call. So thank you both for helping to organize this event. And then an extra special thank you to Shannon, who is also a co-chair, but is also presenting today. So she is doing double duty. So let's start with the topic. So we have two leaders in their fields, Shannon Blackmon of Thomas Dahl and Kevin Kropp with Vanguard Real Estate. Shannon is a CFP, a certified financial planner. She is trained in financial planning and investment management. Shannon co-creates custom financial plans with the guidance of her clients through a comprehensive wealth management process, and she provides insights into cash flow, risk management, investments, and philanthropic goals, which is particularly warms my heart. Shannon is also the co-chair of the PAC, as I mentioned. Kevin is our other presenter, Kevin Kropp. He is the sales manager of Vanguard Properties Castro Street office and has been an agent with Vanguard Properties for almost 14 years. Kevin brings extensive as a top producing realtor in San Francisco. Kevin works as a mentor and an advisor to new and well-established agents, helping them to learn and navigate the complicated nuances of real estate. Kevin also understands the market from multiple perspectives, as he is a realtor, but he's also a landlord. He's owned various property types. Kevin is very much involved in, the real estate community here in San Francisco. So thank you both for agreeing to do this for us. And again, please ask questions. With that, Shannon and Kevin, take it away.
Okay. So inflation is top of mind for most of us. So I thought I'd share some insights on the impact of inflation. I'll start with the history and talk a little bit about the historical data. I'll talk about the present and what's happening now. And then finally, I'll talk about implications for the markets and for us as investors. So what is inflation? Inflation is the sustained increase of prices of goods and services over time. And so usually inflation is this invisible force that's eating away at the value of the dollar. But right now it's very visible, and we can see it in the increase of food, shelter, and energy inflation. So let's look at inflation over time to see where we've been. So here's a look at inflation over time. And this peak here is post-World War II. They took off the price controls, supply controls, and this is just pent-up demand at this first thing here. This is the Korean War. This period of time between 1965 to 1982 is what we call the Great Inflation, and it includes the oil shocks of the 70s. This is the invasion of Kuwait. This is the rising gas prices right before 2008. So you can see in the big scheme of things, it's not the worst that it's been historically, right? But for the past 40 years, it's been in a relatively predictable range. So that's why this recent spike in inflation has been such a shock. So if we take a closer look at what's just gone over the last year, it looks like inflation peaked in June of 2022 at 9.1%. But still, even though it's gone down, it's still 3 times the Fed's target rate of 2%. So in January, these numbers came out on Valentine's Day. January, it was 6.4%, which was just still a little bit higher than what we had thought it would be. We thought it would be around 6.2, but it's still down from 6.5 in December. But still, this is the lowest that it's been since October of 2021. So there was a slowdown because it's a basket of goods, right? So not everything is inflating or deflating at the same rate. So there was a slowdown in food prices, slowdown in the cost of used cars and trucks, but the cost of shelter and energy increased faster. So compared to December, the consumer price index actually rose 0.5%, which was the most in 3 months, mostly due to the higher cost of shelter, food, gasoline, and natural gas. So inflation is the diagnosis, and raising interest rates is the treatment. But treatments have their side effects, which I'll talk about. So to combat inflation, the Federal Reserve has been raising interest rates. So the Fed has a dual mandate to promote maximum employment and stable prices. So when there's high inflation, the Fed raises the interest rates to try to contain it by increasing the cost of borrowing. And this affects investors in the following ways. For one thing, the bonds that we bought in maybe 2020 with the lower interest rates are now worth less in the market. Because who would want a bond that's paying less than 1% when you can now get one that's almost 5%? So last year, clients saw a drop in their bond values in their statements, and their overall return was hit not only by the decline in the stock market values, but also the value of bonds dropping too. But it's important to remember that if you hold a bond to maturity, you still receive the stated interest rate plus your principal back, even if they're marked to market. So I think that's a good distinction to remind clients of. So what can we do to strengthen our portfolio? Here's a look at today's fixed income yield curve. Show you. And this is hot off the presses, today's rates. The silver lining in all this is that there's now less risky places to invest, since the current bond yields are over 4%. So you can see here, you can invest in a 1-year US Treasury at 5% right now. And these change every day, but this happens to be today's. And what does this have to do with the price of stocks? Well, as you can see here, the short-term treasuries, like in the 1-year to 5-year range, have a higher interest rate than the long-term. And this is a little bit counterintuitive, because if you were to loan me, let's say $10,000 for 10 years, wouldn't you expect to get a higher interest rate than if you loaned it to me for 3 years? Because 10 years is a long time. Like, anything could happen in 10 years. Well, that would be the normal yield curve. But what we're seeing today is that investors are expecting sustained higher interest rates in the short term. And so this is called an inverted yield curve. So one thing about the yield curve and an inverted yield curve is that historically it's been an indicator of a recession, because the last 5 recessions were preceded by an inverted yield curve like we're seeing here. Although, like with 2020, the recession was definitely caused by COVID, right? So that reminds us that correlation does not equal causation. So stocks are a proven hedge against inflation, and one of the primary reasons that we invest is to outpace inflation. And so US stocks have a lengthy track record of outperforming inflation over long time horizons. Small and value stocks tend to outperform large growth stocks during inflationary periods. But how do rising interest rates affect stocks? Well, it's true that higher interest rates tend to lead towards higher borrowing costs for companies, which can lead to lower profits. But there's no historical relationship so far between higher bond rates or interest rate hikes leading to lower equity returns overall. So there are a couple options that are specifically designed as a hedge against inflation, which are TIPS and I bonds. So a traditional bond, the principal and interest payments are fixed, and so that value can be eroded by inflation. But TIPS, like you'll see on the second line here, are Treasury inflated protected securities. They're issued by the US government, and the principal and interest payments increase at the same rate as the consumer price index. So it seems like a no-brainer to choose TIPS, right, when we're in an inflationary environment, because the market is efficient, prices already reflect what the market expects future inflation to be. So there's no way to game the system. TIPS are best as a hedge against long-term unexpected inflation increases. Now, there's information in the price of TIPS, and it's specifically in the break-even point between the price of a TIP and the nominal bond in the same time horizon. So if you look at the 10-year, this 10-year column here, the difference between the treasuries and the TIPS is 2.4%. And so what this means is that the market expects inflation to be 2.4%. So over the next 10 years, today's investors expect inflation to be around 2.4%. Now, it's just an expectation. It's not a prediction. But when you're constructing your portfolio, you can think, do you expect inflation to be above 2.4%? If you do, then you might want to include some TIPS in your portfolio. If you think it will be lower than that, then a traditional bond would be a better fit. But of course, it wouldn't be a bad idea to have both types in your fixed income portfolio going forward. Now, another option that's inflation protected are I bonds. So I bonds are inflation protected securities. They're savings bonds offered through treasurydirect.gov. And the current interest rate is 6.89% until the end of April. And then it will adjust with inflation. Now, the I bonds inflation or interest rate adjusts with inflation twice a year. And there's some caveats to these. They're not completely liquid. You have to wait 1 year to cash them in. And if you cash in before 5 years, you lose the last 3 months of interest. They're meant to be held long-term. And because rates change biannually, there's no way to really see what the long-term rate is going to be. So, but there's more that you can read about these on treasurydirect.gov, like how much you can put in and when and stuff like that. So with all this, like, what do we do? What do we do as investors ourselves? What do we tell our clients to do? How do we manage the impact? So first of all, I would say focus on what we can control. Go beyond the headlines and ask your clients how inflation is actually affecting them. And this is one of my great risk tolerance questions too, is like, what was your experience during the dot-com boom? What was your experience in 2008 and 2009? And let people tell you their life lessons. And sometimes if you ask how inflation is actually affecting them, you can get beyond the fear of the headlines and realize, oh, you know, I'm okay, you know, so. Number two, get back to basics. Now I'm doing a lot of cash flow and budgeting with clients right now, no matter what the income level, because I want to get really clear on the spending number because it's changed a little bit. And this spending number is what the Monte Carlo is based on and retirement projections are calibrated to. And also I feel like even though these are rough times, I like that inflation is not this invisible thing anymore, that it's a tangible thing that we can talk to, because it makes it easier to explain why we're saving and investing. Number three is manage cash. So it's a really good time because the interest rates have risen. It's a good time to shop around for the best rates for high yield savings accounts. Because I still see people earning close to 0% in regular brick and mortar banks. So I encourage you to try to find FDIC insured online savings accounts that spend less on overhead and marketing and can provide you better rates. Also, we never like carrying consumer debt, but be especially cautious right now as interest rates are rising. One thing I read the other day is that average credit card interest rates are above 20% right now. So we want to encourage everyone to be off of credit card debt right now. Be tax savvy. So for high income earners, your income might be rising faster than the IRS makes its inflation adjustments, and that can cause tax bracket creep. So use opportunities like the tax break for charitable contributions. So a donor advised fund, like we have through Horizons, allows you to group multiple years of giving into 1 year and increases your deduction. And we also have clients use a strategy of giving every other year to bunch contributions to lower their tax bill. And finally, keep things in perspective. And speaking of charitable giving, like, what does this economic environment mean for charitable giving? Well, inflation is a headwind for charitable giving, not only because of the uncertainty that donors feel, but because the need from organizations have a greater need, and the people they serve have a greater need. So there are tax benefits for giving, but the best thing about giving is that it benefits the giver, the receiver, and the community. So let's proactively encourage giving because it promotes financial well-being, holistic well-being. It's impossible to feel lack when you're giving, and it puts things in perspective. Now, these are a couple questions that I get asked a lot, and I'm so glad that we have Kevin here who can help us answer them, because people ask, with these rising interest rates, with the cost of housing now, is it a good time to buy a home? And I'd love to hear Kevin's insight on this. My answer is yes, it's a good time. As long as your cash flow is right, it's an excellent time to buy a house. Because if you think about it, what your mortgage does, well, I mean, if you have cash, great, then you don't have to worry about mortgage rates at all, right? You can take advantage of the softening prices, but what a mortgage does is it locks in the cost of shelter. So that's a hedge in inflation itself, because the cost of your housing is not going to go up. And if you get a mortgage now and interest rates go up, well, then you've happened to get in at the right time. And then if interest rates go down, then you refinance. And I'll let Kevin talk more about, is it a good time to invest in real estate, investment real estate?
Yes, thank you, Shannon. So just so everyone knows, I'm a real estate broker at Vanguard Properties. I've been doing this actually longer than my bio says. It's 18 years now, not 14. And I manage an office of about 60 agents, and am currently the interim broker for Vanguard Properties, which is a $4+ billion company a year throughout the Bay Area and locally owned and operated. When it comes to real estate, the big difference in real estate is emotional. And what happens is we like to watch the news and hear the sky is falling averages across the Bay Area, and that there's multiple bids, there's no bids, there's 3 homes on the market for 35 million. Are they going to sell? Somebody else just sold their house for 200,000 under the asking price. What does it all mean? So the problem I have with averages is they're wrong 99% of the time. And most people don't look at their home as an average property or a below average property, even if it may be. We all think our child is the cutest, our dog is the cutest, which is in my case, my dog is definitely the cutest. And we think our home is the best. And what's really important to do is to really needle down on the market and look at what is a comparable property and what isn't. So the other thing to think about is, what in the question of is it a good time to buy, is there's something you get out of real estate that most people don't put a value on, and that's the utility of living in a home. So if you're just buying a home for pure investment, that's like buying a stock where it either makes sense or it doesn't. But if you're buying a home for the utility of living there and quality of life, and I've worked very hard to be able to buy this home, then you want a home that serves a purpose, whether it be a home with a view or a home with a flat yard, a home on a hill, a home with room for a pony, a home in a condo building with services. So those all have different values to different people. What I'm seeing right now is 2 markets. There's the people who want to pull their money out of the market because they can do better with their money in either a different area or a different type of investment, and they're willing to move that money into other investments. I have a lot of people that are stepping up in homes because they can get more for the price point, even if money costs more today than it has over the past few years. There's also the lack of competition in the marketplace. So what we're seeing is a really bifurcated market where one property will appeal to one type of buyer and another submarket will have no buyers in it. So like luxury towers, we're seeing they've been really depressed for the last 3 years because during COVID, everybody wanted to get out of high-rise living. And now we're seeing people flood back because they say, oh, I can buy a penthouse for $2 million. And last year, or a couple of years ago, it was $3.5 million. So they're seeing the value there. And other people during COVID, they all wanted outdoor space. So single family homes with yards went through the roof while condominiums were really depressed. And what we're really seeing is a balancing of the market. And to answer the question, is it a good time to buy? It really depends. It depends on what your needs are and what your wants are. I have people that are in houses that are too big and they just don't want to pay to heat it or insure it or carry the property. And other people that need more space because a lot of people are working from home. So along the lines of working from home, Salesforce announced recently that they're going to mandate 4 days a week back in the office. And that's expected to be starting this spring. And we're expecting other tech companies to follow. So a lot of people actually moved out of San Francisco in the Bay Area. I've got clients in Austin, in Colorado, in Arizona, and Palm Springs that are calling and saying, I have to get back to San Francisco or else I'm going to lose my job. So they were able to live in much lower cost of living environments and still make a Bay Area salary. Other companies are saying that if you're not in the Bay Area, we're going to adjust your income down. So there's a lot of movement laterally as well as up and down in the marketplace. And inflation is on everyone's mind. It costs more to own a home at 6% or 7% interest than it did at 3 or 2 3/4. But we're also seeing prices come down. So we are seeing monthly carrying costs go up considerably for a home. And I have a lot of people that are just getting priced out. So another thing we're talking about with clients is, we need to price it realistically where the market will support it and price the properties where you're willing to accept the offer. The overbids are not happening like they used to, although there are properties that are getting multiple offers. So it's really property specific and location specific. The south side of San Francisco and Silicon Valley is doing very well. Marin has virtually no inventory and is getting multiple offers on properties that don't even make it to the market. And then I can show you a property that's been on the market 300 days. So I think the real, and I just so everyone knows, I'd love to have a conversation about this and not just be me, Shannon and I talking at you. But it's really difficult to generalize in a changing market because there's so many factors that are moving right now. And the biggest thing I'm seeing is consumer confidence is really at a low point. We are seeing the commercial market in downtown San Francisco has a vacancy rate somewhere in the 40 to 50% range. The counterpoint to that is Silicon Valley jobs report is showing a lot of resiliency. And so, and I know we've heard about the big layoffs from the big companies. What that's actually resulted in is some of the smaller startup companies getting great help where they couldn't compete with the salaries of Apple and Google and biotech companies who may be trimming back some of the fat. And those people who are very talented are now going down to some of these startups. And we're seeing huge growth in artificial intelligence in the Bay Area. So that may be a future place for people to look, who may be willing to be a little more speculative on the marketplace. But we're seeing a lot of strength in that market, and we're getting clients that are working in those fields that are very bullish on the future. And they're willing to pay big dollars for homes because they see the future very differently than maybe the average person who's looking at their portfolio. So does anybody have any questions? I mean, I have a lot of data points, but I just don't want to like throw them at you and have them mean nothing. You're on
Feel
mute.
free. You don't have to necessarily type them in the chat. If you want to unmute and ask the question, feel free to do that also.
Barry?
So I'm curious, when we talk about inventory in San Francisco availability, and the vacancies that we have in the financial district, what do you know, if anything, about directions to maybe convert some of that property to residential as opposed to office?
So I guess this comes with a warning of don't get me started on San Francisco Planning Department. It's a very challenging, I think there's a lot of well-intended people out there who make a lot of rules and laws without testing them legally against the current policies for the city. So I mean, I know some hotels have been changed into short-term rentals. I work with a lot of developers, and they just tell me it takes 3 to 4 years to get a house approved to build. The city says one thing, but their actions say another. For example, I own a property that's 3 units, and one department told me I couldn't have the 3rd unit, and the other department said I couldn't remove it. So the only solution when I talked to my lawyer was to sue the city, which I wasn't interested in doing because I don't have endless bank accounts. But so I don't really have an answer for you as to are they going to convert commercial to residential. But I personally believe it would be very hard, and even with well-intended people who want buildings to come out of the ground, there's whole groups from every neighborhood that show up and say, we don't want that building, we don't want that type of use, we don't want that density. So it's just a very long, drawn-out process. And so if you own a home or an investment, what it means is that your home is worth more because supply is expected to remain relatively low. And absorption currently is, like I did a year over year. Last year, year to date, 687 properties had transacted on February 28th. And this year is 408, which is about a 40% reduction. The average price last year was $1,641,000. The average sales price this year is $1,457,000. So that's down about 11%. The average price per square foot last year was $1,115. The average price this year is $961. So that's down about 13% or 14%. The counterpoint to that is the highest sold property last year was a condominium, 4-bed, 5-bath, and it closed at $8.8 million. And the highest sale this year is a condominium, same size, sold at 2863 Green Street, and it closed at 9995. So there's a lot of conflicting numbers, and it's really important, and this may be true in Shannon's world as well, but you not only have to look at the average, but also look at the median, because there are anomalies out there that will skew the averages drastically. And if you take that average data point and apply it to an investment or a property you're considering or a property you own, that average may skew you in the wrong direction, either up or down. But the median sale, if you look at median sales prices, they, in the case of an anomaly, say there's 10 sales and 10 of them are at $1 million and one of them's at 30, the median price is going to be much closer to a reality than the average price. And that's just an extreme example to prove a point. But Shannon, do you see the same situation with averages and median in your world?
Yeah, I think there's different ways to look at the data, and some of them can be skewed. I think a lot of times you say that investing in real estate is emotional, like all investing is like that, especially real estate. But we have these biases, that tend to make things look different. Like things that happened more recently, we think are, going to happen again. And so there's those different things, just our own behavioral biases when we're looking at data.
Yeah, and my client base, everyone feels like the day they close escrow, there's going to be an earthquake and the house is going to fall down, which I think we've all had that fear of, I'm making the largest purchase of my life, and what if the earthquake hits tomorrow and I lose everything, which I think is a valid fear. So, but the utility factor is something that a lot of people don't calculate in real estate. So you're not only getting the growth of your asset, but you're getting the utility to live in the home. So I find that buying investment property is a very different exercise. And it's, if I put 30% down, what's my return on investment plus my growth? What's my expenses? What's my cash flow situation? Which I think is much more like buying a stock in my mind. But I talk about houses like cars are the same thing as a house. They all serve the same purpose. But when you get into a Rolls Royce or a Bentley, you feel different than when you get into a Honda Accord. There's some houses you walk into and you get that feeling. And I always talk about the smell of a new car, which is the toxic off-gassing of plastics, but we all love it. And we get in there and we take a deep breath and say, oh my God, I love this new car. That's the emotional connection to a new vehicle. I want to look sexy. I want to look practical. I want to look rich. I want to look, reasonable, whatever the situation, or I just need utility. I need a truck to get me from A to B. A home actually serves the same purpose. A studio has 4 walls, a bathroom and a kitchen. A mansion has 4 walls with a lot more in between, a lot more bathrooms and probably a lot more kitchens. But they do serve the same purpose. And what you'll see is there's blue chip stocks and penny stocks in real estate, just like in the stock market. So for years, they were talking about invest in Sacramento, invest in the East Bay, invest in the North Bay, buy in the Mission, buy in the Bayview. And where there's higher risk, there's often higher reward. But it's not necessarily the case as in the stock market. So I think you have to find your comfort level in investing wherever it is. And hopefully part of that comfort level is including a charitable portion to your investing. But there's great opportunity to shelter your money from inflation in real estate, especially in the rental market, because you can buy a piece of real estate. If you buy something that doesn't have rent control, you can move rents with the marketplace and hopefully protect yourself from some of the inflation. I own a rent control building, and every time someone moves out, my rent jumps considerably. So I look at that as my long-term savings and that as my 401k. The other thing you can do, and obviously talk to your tax advisor, but there is the ability to convert an investment property into a primary residence with a change of life situation, which can mean retirement or other life-changing events, divorce, health situations. But you can take an investment property and buy an income property somewhere maybe that you'd like to retire in 5 or 10 years down the road, and use that as a rental property to satisfy a 1031 exchange and pay no tax on that gain, and potentially convert that into a primary residence under a life-changing event like I've retired and stopped working. So there are ways to not manipulate, but use the tax code to your benefit, and really grow generational wealth while still getting the utility out of a beautiful home.
Thank you. I have a question. There was a question posed, so I'll read it.
Sorry, I didn't see it.
If real estate is so inflation resistant, why is rates, REITs, why do they go down in value in correlation with stocks?
I mean, not everything is linear in life, and it is resilient in the sense that the values haven't changed as much as other things can change. But yes, there are homes that have lost arguably 20-30% of the value that they may have had in 2021, which was an anomaly year. And what I'm telling my investors is, don't base your portfolio on an anomaly. In 2021, we saw prices go through the roof, and that was clearly an anomaly, and it didn't make sense to even the realtors that were out there selling the properties. It also didn't make sense that interest rates went down to almost 2.5%. The money was free at that point, so why would you pay cash when you could get 2.5%? But people were still paying cash for properties. So if you track real estate on a long term, it has often outperformed the stock market and been a great shelter for inflation. But if you look at it at any investment on a short term, there's good days and bad days. The point is to analyze your investment against your own plan and wants and needs and your life expectancy, unfortunately, and see where you can best cash out of the market if that's your goal. You don't have to sell your home, and that's a great thing for most people. So you can wait for the day when the numbers make sense.
Thank you. Barry?
So Henry, let me add, as a wealth manager, and Jake and Shannon, I'm sure you could echo some of what I'm going to say or correct me. Apologize, I don't know what the rest of you do, but regarding REITs, especially the last couple of years, what we've seen, the areas that have been hit the hardest, the REIT funds that have been hit the hardest, are those that have shopping malls, those that have commercial real estate, so office buildings, etc. And it obviously reflects what's happening in the broader marketplace. Office space, just go downtown San Francisco, we've got a lot of vacancies. There are some REITs that have done better than the indexes, that have done better than others, and those are frequently more actively managed ones that don't, for example, have a concentration in office space or concentration in shopping malls. So overall, the observation that REITs have not held up as well on a broad analysis is true, but there are specific REITs that can be a great hedge against the stock market and against fixed income as well. So those are the ones that you need to, unfortunately, in this market where it's really easy, and again, Shannon, Jake, jump in, but where it's really easiest way to invest, if you're going to invest in the stock market or REITs, is to do it through these index funds where they own a little bit of everything. The problem with real estate right now is you got to do a deeper dive because the broader indexes hold real estate, they hold shopping malls, they hold investments in areas that are not as attractive. So it's simply an area we need to do more homework.
Yeah, I found when it comes to REITs that the public REITs do have a correlation with the stock market. And for our clients, we've had to start looking at the private REITs for accredited investors that, like Barry was saying, are more selective and have a different mix. Usually some, single family residences, but in specific areas. But we like those for diversification while still keeping the tax benefits of owning real estate.
And can I ask, can you give us a quick definition on what REITs is? I don't know what that means.
It's called a real estate investment trust. And so it's like a mutual fund holds a basket of stocks. This is holding a basket of real estate properties.
Okay, perfect. Thank you. Just in case that somebody wasn't clear. Does anyone have any other questions? So we're at about let's see, we have about 15 minutes left in the presentation. So if folks have other questions, we can, I think this, Barry and folks chiming in, I think is very helpful. So if other people have ideas or experiences, please share those with us also, because that may make the conversation, answer some questions for you all.
I'd like to ask Kevin if we used to always, say, well, we can downsize it. We could always downsize, right? Are you seeing that people are able to do that in retirement?
So, I mean, San Francisco is really unique in that most of the clients we deal with are in a arguably different financial tax bracket. So downsizing means different things to different people. I've had people downsize to a 3,500 to 5,000 square foot home. I've had people downsize to a pied-à-terre in Sonoma, a pied-à-terre in Palm Springs, and while keeping a condo in San Francisco. So downsizing is one of those, it sounds like people are downsizing, but they're just creating multiple homes instead of just truly downsizing. I think that we do see people looking at what they need differently over the last few years. Being locked in our houses has changed the value of our homes. I think we all look at our homes differently. The other thing is there's a lot of people out there who have interest rates under 3%, myself included. So why would I sell my house? And even if it was a lateral move, it would cost me probably $3,500 more to live in the exact same home in San Francisco today with a higher tax bracket. So just like when everyone bought their cars, I don't know if all of you remember, but there were years when cars were at 0% interest and Detroit needed help. So they put 1 billion cars out on the road at 0% interest. Everyone went and got a new car, and then nobody needed a car for the next 5 years. We're seeing that in the housing market where people have me come and tell them about the value of their home, and they bought it for $500,000 and it's worth $3 million today. And they say, okay, that's great, but where are we going to go? So just like when you're planning an investment strategy, what's your out? What do you need monthly at retirement to have the same standard of life? Whether it's 10 grand a month or 30 grand a month or 50 grand a month or more, we're having the same conversations with homeowners and investors as to why should I pay the tax to live in a smaller home to pay more for it. And that's why if you look around the Bay Area, there's a contractor in front of it's hard to go down a block where there's not construction happening because they're keeping their low tax bases. A lot of people are waiting till they can transfer their tax base, which is a great thing. A lot of people are doing 1031 exchanges and reorganizing their portfolio. A lot of people are moving money from the stock market into the rental market. The 2 to 4 units is a very popular area for small investors because they're bullish on San Francisco long term. So it's interesting But just like with investing, you have to sit down with the client and talk about where the risks are. Some people don't want to be a landlord in San Francisco. They're afraid of it. I've been a landlord for 25 years, and I firmly believe that 99% of tenants and 99% of landlords are wonderful people. And all we talk about is the 1% and how they destroy the market on both sides. There's horrible landlords and horrible tenants. There was one on the news last night in Alameda who hasn't paid rent in over a year and a half because Alameda is the last county in the Bay Area with the COVID restrictions for eviction. So the tenants also bought a home and make over $200,000 a year, but refuse to pay rent right now because they can. And nobody can evict them. And so the Board of Supervisors in Alameda is meeting tonight to potentially remove the eviction restriction under COVID. They're the last county to do that. So I mean, there are horror stories, but I didn't have a single tenant that didn't pay their rent all through COVID. And I only reduced one unit, reached out to me and said, hey, I had to take a reduction. Would you be willing to lower my rent $400? And I said, of course, you know. So I think you really have to talk to the individuals as to what their short-term and long-term goals are and what their risks are, how risk averse they are before I can advise someone on where their investments should lie. For some people, triple nets are great. If you don't know what a triple net is, it's a property. Often they're like you buy a Starbucks or you buy a Subway, and the tenant pays taxes, insurance, and the rent. But they don't tend to change in value. If you bought one for $1 million today, it'll be worth probably $1 million in 5 years or 7 years. But you're probably going to be getting $15,000+ a month out of the investment. So they're more about cash flow and less about growth, where buying a home or an apartment building is maybe less about cash flow and more about long-term growth.
Very good. We have a question from Howard.
Thanks, Henry. We've seen a number of senior communities built in the city and in the Bay Area, and a lot of Horizon's clients own property. I'm wondering if anyone has any thoughts about how senior communities, the one where there's buy-ins, how will they appreciate versus how non-senior properties will appreciate?
So I have a listing coming in Rossmore, which is a senior community out in Walnut Creek. We see them lag behind the market in growth, but they still grow because often they have higher HOA dues and often they have some level of assistance as people need them. So there's the luxury end, the kind of Ritz-Carlton level $30,000 a month HOA dues. And, there's a 5-star chef in the property, etc. Those also, because of the HOA dues, they don't tend to move with the normal market. But we have seen some growth in them, and but it's marginal. You're not going to make a lot of money, in my opinion. But I have a client who bought one for $700 and some thousand about 5 years ago, and I think it might be worth around $900 today.
You're on mute, Henry.
Thank you.
We have a question from Barry.
It's actually not a question. Let me make a quick point that might benefit some of you, might benefit your clients, and could benefit Horizons at the same time, picking up on the theme that Shannon led with. And it goes back, Kevin, to the discussion about downsizing. Horizons has been fairly successful this last year. We have what's called a legacy committee, and the group works with people who are interested in leaving legacies behind. And through that work, we have had some clients this last year who are downsizing. meaning that what we see is that the average individual, most of their net worth is tied up in the equity in their home, if they were lucky enough to buy a home way back when, or the retirement accounts, because retirement accounts are fairly easy. Employer sets it up, you put money in it. So at the time they reach retirement, they don't have a lot of liquidity. Equity in a home does not produce cash flow. And any money they take out of their retirement accounts, they've got to pay taxes on. So we've seen situations through Horizons where individuals have come to us, they have a home, they do want to downsize, and by in their definition, what they mean is they want to get a smaller place, less debt, and they also would like to free up the equity in their home. And to your point, Kevin, you know, if you just sell your home outright, well, you've got to pay capital gains taxes. And in a rental property, not only do you have to pay capital gains, but you also have to pay taxes on depreciation that you've taken over the years. So getting out of a property to downsize can be an obstacle. What we've seen on a couple of cases with Horizons, we've seen people sell property in San Francisco. They've owned it for a long time, have a lot of equity. They buy a much less expensive home in Palm Springs, for example, different lifestyle, obviously different strokes for different folks. But by creating a charitable trust and moving a portion of the residents into the charitable trust, they actually avoid the taxes on the sale of the property. They end up with money in a portfolio that's liquid that they didn't have before. And of course, ultimately charity benefits. So there are tools that those of you who may not be aware of it, you can check with Horizons and give you some guidelines on setting up charitable trusts that of course benefit society, but also provide a shelter for those individuals who want to create some liquidity, want to cut overhead costs in retirement, and want to avoid the taxes. Just an idea.
Great. Thank you for that, Barry. That was I think with that, we will, we're getting to the end of the presentation. So I will turn it over to Shannon and Kevin if there's any closing remarks that you want to make, and then I will do some quick wrap up.
Shannon, you want to go ahead?
Yeah, not much more to say. I really appreciate Barry tying it all together with how we can give back and with that wonderful strategy. It was wonderful speaking with you today and getting to speak with Kevin. Thank you.
Thank you. The only thing I have to add is if you think this is all doom and gloom, in 1692, tomorrow the Salem witch trials started. So the good news is, regardless of where your investments are, you're probably not going to be burned at the stake. So congratulations for that.
Thank you. So thank you to our presenters for presenting for us today, and thank you for all of you who took the time out to join us today. As you know, Horizons is a community foundation for the LGBTQ community, and if you feel inspired to support the organization, please feel free to do that. You can also support the PAC directly by designating, if you want to make a gift, you can designate it to PAC related programming, and we'll use that money to be able to bring you more presentations, part of our pro bono day. It will really kind of help us to continue the PAC grow. You'll also be receiving a survey shortly with the link to the video, and please do fill out the surveys. They really are important to us. We particularly are interested in the topics that you want to hear about, so please share with us the things that in future presentations you want to hear from us. We really do value that input. And then the other, probably second most important question, or maybe even the most important question, what time do these work for you? Does noon work? Are these better served morning, after? Please let us know when we can do these, so we can do the best we can to bring you the content at the time you can actually. So thank you again, and hope everyone has a great day. Stay safe, stay dry. And if you have any questions about Horizons and any of the donor advice funds or things, please reach out to me. I can help. And with that, thank you.
Thanks, everyone.